Hello, today we're going to be doing a quick analysis of ticker symbol JNJ, Johnson & Johnson, because they most recently just sold off a sector of their business because they held a lot of shares of a company, and then they got rid of like 85 percent of the company, so now they only own 5% of it. That's how many shares they have left. So we're going to look into that. It's going to take a big chunk of revenue. Their guidance just went from 98 billion to only 84 to 85 billion. So that's a big chunk of the sector that's coming down. But we're more worried about their free cash flow and their dividends. That's how you're going to value a company like Johnson and Johnson. As you can see here, the last quarter that just ended, their net income increased 6%. So they're still growing their net income, which is good. That's going to reflect on the free cash flow. Free cash flow, that we'll look at this real quick. As you can see over the last 12 months, this is the trailing 12 months right here, TTM, only 9.33 billion. So see, over the other months, you can see the trailing 12 months what the free cash flow was. So that's something to keep in mind. But also look here, repayment of debt, an issue of debt. So see, this is something that's happened in the last 12 months, and you can see the difference here between these numbers. So that also pays into their free cash flow. We'll also look at their liabilities, and we'll look at what their assets are. So we're going to come over here, like I was talking about. So we're going to take a quick look at their net income over the years. As you can see here, it's constantly increasing. 2011, it was only 9 billion, and 2022 it was 17 billion. So they have doubled that in over the last 10 years, basically. As you can see, 2021, 20 billion. That was really good. So they are growing that net income always, which is a good thing. You can see it over here too, quarterly. So over the 12 months, this is trailing 12 months over here on the quarterly. But we're gonna go over here to their revenue, and their revenue, as you can see, is decreasing. But that's also going to be, well, you can't see it as decreasing, but I meant to say is it was increasing, but it's going to be decreasing because, like I told you, they sold off that sector. So that's going to bring them down to about 84 to 85 million, which is higher than 2019, which is a good thing because what was after 2019? COVID. So what did we see? A big jump in revenue from Johnson & Johnson after COVID. So we have 82 billion 2020, 93, 94, and then the trailing 12 months was at 97. So they're going to be coming back to realistic expectations because, as you can see, from 2010 up, it was growing, 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 and then kind of steadying out at that 82 billion range for 2 years. So we're going to be right back to normal. So we're going to base it upon that. And you can cut the shares outstanding, and Johnson & Johnson is a great company. They're always buying back shares. Sure, it's not a lot, but as you can see, it is decreasing. So it's down from 2674 to 2626. So they are, having a little bit of buybacks. Their EPS, as you can see, over the trailing 12 months, it was 4.93. So we can put that in the calculator too, just to get an idea of what it would be like, as Benjamin Graham. So we're going to come over here. We have our DCF calculator, and here it is from 2013 to 2022, their average free cash flow. 5% growth rate, because as you saw, they were growing their net income at 6%. 10% discount rate, perpetuity 2%. Shares outstanding 262 or 2626. Brings us to a discounted cash flow analysis of $116.56. If we come to our more aggressive one, it's going to bring it to $132, $129.32, $116, 10%, which is the same as, basically doing it the other way. Our dividend discount model, this is Johnson & Johnson. 4.76 is their current dividend, 5% growth rate, 8% discount rate, $166.60. And then give yourself a 10% discount rate, 15%, and 20%. We come over here to our NAV, and they currently have 191 billion in assets, 115 billion in liabilities, divided by total shares. That gives you a net asset value of $29.09. Our Benjamin Graham, As you can see here, we're going to lower that because of their trailing 12 months. Whoops, that's supposed to be a 4.93. Their 5% growth rate's already in there. 4% bond rate, 20 growth PE. That's going to bring us to an intrinsic value. So if historically about 3% for the bond rate or 3.5%, it'll change this. But I'm going to use 4%, but 3.5%. As you can see, it changes it a little bit, but I like to be conservative, so 4%, because times do get hard all the time. But yeah, if you're a dividend investor, they're going to continue to grow it at 5%. Their most recent one was 6.5%. Then you're looking really good at 166 for a fair value point. If you need a discount rate, though, as you can see, it's going to bring it down to $149.94. Discounted cash flow, because as you can see, they're currently trading at a premium compared to their discounted cash flow at a 5% growth rate. If they were able to grow it, by that 6.8%, let's see, watch, like they currently are. If they were to continue to do that, it would give us $132.80. So if I'm using a discounted cash flow analysis, then I don't want to buy them. If I want a business that has a sustainable payout ratio for dividends, then yes, I would invest in Johnson & Johnson based upon this, because this is 5% and they're growing higher than 5%, as you can see here. If you go to dividends, their dividend yield is currently at 2.79%, a payout ratio of only 44%. So that means that it is sustainable. They have 15 years of consecutive dividend growth according to tip ranks. But if you go down here, see 1.13 to 1.19, 1.06 to 1.13, so it's consistent. But yeah, I currently am staying away from Johnson & Johnson, but let me know what you think.